Hello, everyone, and welcome to the quarterly investor call for the UTI India Dynamic Equity Fund. We're delighted to have you with us today. Let me quickly run through the agenda for today's call. A quick introduction and welcome by Shweta, Head of Products at UTI Investments. A macro update on India by Vetri, Chief Executive Officer of UTI AMC. This will be followed by a fund update by Ajay Tyagi, the portfolio manager who's managing the fund since its inception. Before we begin, just a few housekeeping notes. Today's session is being recorded. We'll conclude with a Q&A session, so feel free to submit your questions at any point during the chat, any point during the session with the chat box. With that, let's get started. I'll hand over to you, Shweta, for the opening remarks.
Thank you, Neha. Welcome, everyone, and thank you for joining us today. Before we dive into India, I want to start by talking about the environment we are currently in. Starting with interest rates. Central banks around the world are maintaining elevated policy rates longer than consensus anticipated. Globally, growth has moderated from pandemic era levels. And for emerging markets like India, this backdrop materially influences capital allocation and investor risk appetite. Just 3 months ago, India was positioned for a genuinely Goldilocks regime. Growth was solid, the RBI had started cutting rates, and the narrative was more rate cuts are coming, growth is accelerating, and inflation will moderate. Then the war happened and disrupted the scenario. With this war, energy supplies tightened, oil prices spiked, currency depreciated, and inflation concerns emerged. India's central bank, the RBI, has now paused its easing cycle. Growth expectations are being revised down. And now the easy narrative has become India's moment has passed. But here's what matters to think through that clearly. There's a very critical difference between a market cycle disrupted by an external shock and a structural breakdown. And that distinction is worth understanding because it changes everything about how we should be thinking. What distinguishes recovery positioning from capitulation is often not analytical rigor but behavioral discipline. For investors invested in India, the portfolio drawdowns have certainly created real pressure. Right now, the impulse to reduce exposure is not merely a rational calculation, but a direct response to experience loss. The challenge is maintaining conviction regarding fundamentals precisely when this conviction is most difficult to articulate. And this is where discipline matters. For India, the fundamentals that matter capex growth, credit deepening, real wage growth, consumption these haven't reversed, they've slowed. However, the structural underpinnings of India's long term growth are still intact. So we have to remember India wasn't an investment thesis because the next 6 months would be smooth. It was because India is in the middle of real transformation, urbanization, manufacturing, digital adoption, 1.4 billion people moving up the income curve. Those themes don't disappear in a cycle. Instead, they get cheaper. So, currently in Indian markets, the market may be pricing in cyclical stress as if it was structural. But it's important to remember that cyclical stress, however painful, is not the same as a structural breakdown. This cycle will turn. Nobody knows when, but the time to remember that is usually when sentiment says to forget it. With that context in mind, we will now get into the specifics of India Macro, followed by an update on the India Dynamic Equity Fund. Thank you, and over to you, Neha.
Thank you, Shweta, for that great overview and quick snapshot. I'll now hand over to Vetri, who will walk us through the key macro trends shaping India's economy. Over to you, Vetri.
Sure. Good morning, good afternoon, good evening, wherever you're joining this webinar today. I think Shweta has already sort of laid out quite a bit of detail about the kind of world that we live in. But being the sports fan that I am, I have to admit that this weekend, the French Open was a complete delight to watch in terms of the unpredictability of sport. You had a Polish tennis player ranked outside the top 100 who did not have the ability to pay for her hotel for more than 3 nights, who eventually made it all the way to the finals. So it's just wonderful to see that, sort of a fairy tale play out. And then in the men's final, you actually had Alexander Zverev, who everybody expected to be a Grand Slam player many, many years ago, a winner in the Grand Slams. And then finally, when nobody thought he was a potential candidate, one or two of the favorites got knocked out, and then he goes on to win his first Grand Slam. So, the world is always full of the unexpected surprises. And I'm sure even in the markets, there'll be many more unexpected surprises that we'll get to discuss in these webinars in the months ahead. But getting that out of the way, we'll just jump into the macro environment in India. And this time we've just kept it very, very specific because I know there have been many questions about India's macro. So we're going to dive into the macro trends and focus on some of the points which have been of most interest. Now, those of you who are in the know would know that India adopted this template of inflation targeting way back in 2016. And if you look at the outcomes since then, the Monetary Policy Committee in India has been reasonably successful in terms of ensuring that inflation stays within the 4% plus or minus 2% band. That's the blue line, which is the CPI. The orange line is the core CPI, which strips out some of the more volatile elements. But what you'll see, and this is what I would highlight to you when you get to that extreme right in April 2026, you'll see is that while headline had this massive swoon, core in fact stayed quite stable in the 3 to 4% range. And even with the recent increase in prices, core and headline are now well in line at about 3.5%. The Monetary Policy Committee, or RBI, in its recent monetary policy, did, however, hike its full year forecast for inflation, the headline number, to 5% for March 2027. That's 50 basis points higher than where their previous forecast was. But crucially, it remains within the 4% plus or minus 2% band, which is what actually guides monetary policy in India. So that's where we are placed in terms of inflation. The starting point was comfortable, and therefore we seem able to manage this inflation spike within the comfort zone. Moving on to the next slide. Here we are talking a little bit about the fund flows and the capital account in India. Now, historically, and I've been in the markets long enough to have conversations about India's balance of payments, those conversations about balance of payments have normally been dominated by the trade account. So, what is India's current account balance, or rather the trade deficit? And then how does it convert into the current account deficit, and how is it getting funded? Um, in the last 2 years, actually, what's happened is that the trade account has not really been a pain point. The pain point has actually been the capital account. Now, we've got two slides over here. If you look at the left-hand side one, this shows you the net foreign inflows into the equity market. And as you can see in financial 25 and financial 26, which in both cases is the year ended March, foreigners actually pulled out a cumulative $37 billion out of India. And in just the first 3 months of this year, they've already pulled out another 7 billion. So this is a remarkable outflow of capital out of India. And when you look at the chart on the left, which goes back 20 years, you'll see that this is almost unprecedented in terms of the scale of withdrawals. In fact, in 5 out of the last 6 years, you've actually seen outflows from foreigners out of India. Now, this relates only to their transactions in the equity markets. When you look at the chart on the right-hand side, we've tracked the movement of the capital account over a 2-year period. So where were we in FY24 and how has it transformed from FY24 to FY26? So we start with a FY24 capital account surplus of $90 billion, which means that's the capital coming into India. Now, what's changed as we get to FY26 is that, first of all, foreigners pull out $46 billion from India during this period. So that's a net negative number. Secondly, foreigners in equity have in fixed income have pulled out $17 billion. Then foreign direct investors in India have repatriated, this is both by way of stake sale as well as dividends, they've repatriated $9.5 billion from India. Then, of course, we have a miscellaneous item of minus 4.6. Then you come to the inflows, where you've had external commercial borrowings providing plus $8 billion, new FDI flows into India, providing you $4.4 billion. So, what was a $89 billion support to the Indian economy in terms of the capital account in FY24 is now dramatically reduced to just 24.5 billion. So, it's not just the FPI selling, it's also outbound FDI repatriation, and which has caused this number to decline quite significantly. And this, to my mind, more than the trade account, is responsible for some of the challenges that we've experienced on the currency side. Moving on to the next slide. Yeah, I won't spend too much time on this. This basically is just to show you 2 points. One is that, when with this, restriction in supply because of the blockage of the Hormuz Strait, supply has been dramatically reduced. What the world has done on the left-hand side is basically run down the storage which was available and floating around in, global oil systems. So we've not seen price spike as much. It has, of course, spiked from where it was before the war, but it has not spiked as much because of the rundown of that floating storage, which has effectively acted as a buffer. On the right hand side, what you see is the dated Brent price, which is really the price for the futures or very long dated deliveries. And what you can see over there is that that price has also corrected lower. But we do expect that as the inventory refill happens, there is a potential for this price to move higher. Of course, this is a moving target just given the nature of the conflict. Now, what does this imply for India? That is on the next slide. Yeah. So what does this increase in crude oil price, what's the fiscal cost? What all segments of the economy does it impact? Now, crude oil prices in India don't directly translate into consumer prices because a big chunk of the industry is dominated by state-owned oil marketing companies, and therefore they have effectively sort of become the buffer. As a result of which, on the left-hand side, what you see is what we call the oil marketing companies' integrated margins. These were very healthy margins, and as you can see, because the price hikes in their raw material did not get passed on, their margins have actually gone negative. Now, if we try to estimate what is the cost of this on the fiscal, you can see over there on the right-hand side, 1.6 trillion rupees would be the fiscal loss on account of the excise cut which the government did, the LPG subsidy which it is continuing to provide, that is liquefied petroleum gas. And if the oil marketing companies take a hit on their profitability, they would not be able to pay a dividend to government. So when we cumulate all of these three based on the current circumstances, the hit to the economy is about 1.6 trillion rupees. Now, fertilizer prices have also spiked significantly. So we would estimate currently that increase to be almost about 1 trillion rupees. There are estimates from MK. So totally that's a negative impact of 2.6 trillion rupees on the economy. Now, however, there are some offsetting factors. The government has raised some of the duties which come through the Economic Stabilization Fund. They will likely cut some of the capital expenditure and revenue expenditure. We are at this point presuming no change in the dividend paid by the RBI, but all of this put together provides the government with an offset of about 1.8 trillion rupees. So net, there is about 790 billion rupees, which is the impact of these current increased fuel prices on the Indian economy, which would potentially create a net fiscal slippage of 20 basis points for the government. If we move to the next slide, This then models what the impact of these higher prices might be on the current account deficit and also the balance of payments. Now, for FY26, the current account deficit was estimated at 0.9% negative, and the BOP was also estimated negative. Interestingly, the fourth quarter data for India in terms of the CAD, which came out day before, was much better than anticipated. So actually, the CAD for the full year now looks closer to 0.6% deficit. Now, what might the current crude prices imply? If we look at FY27, we've modeled that and given you the numbers at three different levels at $90 a barrel, $100 a barrel, and $110 a barrel. This would cause the current account deficit to escalate to about 2.3%, 2.7%, and 3.1%. Remember, the RBI has historically held the view that 2% current account deficit is what it is comfortable with. And then we have also modeled the balance of payment deficits that are likely to happen given the current environment. However, these balance of payment numbers do not take into account the recent announcements made by the RBI, which are significantly positive for capital inflows expected into the economy, I would say, in as brief a period as the next 6 months. In fact, I was looking at the numbers for Citigroup. So a week ago, Citigroup expected that when you look at the BOP deficit, they were estimating it at almost about 50 to 60 billion dollars. They now estimate that gap as down to only about $5 billion. Now, why is this dramatic change taking place in the BOP expectation? You'll see that on the next slide. So when the RBI and MPC made their announcement last week, they've made multiple announcements. You can see a whole laundry list of them, and of course, the team will share this with you. I think the first, second, and third points are very long-term measures. You've liberalized the ability of foreigners to invest in India. You've liberalized the list of Indian government securities, gilts, which foreigners can invest in India. And after much demand from foreigners, finally the government has decided that there is a tax exemption for FPIs on both capital gains and the withholding tax on interest. So this is, I believe, a long-term positive. It will create its own flow of capital, but this is not something which will immediately happen in 3 to 6 months. The policy measures which are likely to have an immediate impact in the next 6 months are the bottom four policies. First, the revised equity investment limit for overseas individuals. Again, hard to ascertain the exact amount that this would bring in. But on the second and third item, which is the concessional foreign exchange swap on ECBs, external commercial borrowings, the RBI has effectively opened up a very concessional forex swap facility. This is very similar to what the RBI had done in 2013. So in effect, they are using the same playbook that they used in 2013 as regards the external commercial borrowings, and also on what we call in India foreign currency non-resident deposits. These are essentially deposits raised from non-resident Indians. What the RBI has offered is that they will bear the full hedging cost on these deposits for a 3 to 5 year deposit period for investors who put in the money for a 3 to 5 year period. And these deposits can be raised up to the dateline of September 2026. Now, when the government of India and RBI used the same playbook back in 2013, the concessional FX swap and FCNRB deposits, last time the rules were slightly different. Cumulatively, these two raised almost $34 billion. Given on what has been announced in the recent days, we think that $34 billion, and there are various estimates out there. I gave you a 50 billion number, which Citigroup is estimating. Jefferies thinks it could be 70 billion. MK thinks it could be about 45 billion. But I would say 50 to 70 billion is sort of the number that we think is potentially the capital inflows which could happen on account of the concessional FX swap on external commercial borrowings and FCNR borrowings. And as a result of that, what could have been a gap of $90 billion in capital flows might actually come down quite dramatically. And as Citi says, the gap could be down to just $5 billion. So these are very proactive measures that the RBI has taken. And I think this will certainly stabilize the currency account. And we can talk more about this later. Moving on to the next slide. Um, this just gives you a simple snapshot of India's real effective exchange rate. After many years where it fluctuated between the baseline value of 100 and overvaluation, if you actually look at this chart, remember from 2014 all the way to 2025. So there's a 10-year period where the currency stays at baseline or overvalued. And for the first time, because of this fall in the last 18 months, we've come into undervalued territory. Not as cheap as it got during the taper tantrum in May 2013, but not too far from that either. So I think for the first time, from a pure REER basis, the Indian currency is now very clearly in undervalued territory. So moving on from that, we'll now sort of just pivot to this chart that we very often share with you. As a result of India's underperformance, both in terms of currency as well as in terms of its market performance, interestingly, after a long time, this line, which indicates its share in world market cap, has dropped below India's share of world GDP. So just another indicator to sort of tell you that, there's been more than a degree of mean reversion in India's valuations relative to the rest of the world. Moving on from this to the next slide. Now, here, of course, we are looking at a standard valuation parameter. And I must admit over here, things continue to look a little more challenging. India remains expensive vis-a-vis other markets. So on the left-hand side, you've got a chart which shows you, where the current forward P multiples are, which are those orange dots. The US is the costliest game in town, but India still remains relatively expensive on this metric, at least based on the MSCI numbers. And on the right hand side, you can see the challenge because of cyclical markets like South Korea and Taiwan having some, record earnings growth this year, 30-35% as compared to India's earnings growth, which is a lot more middling, just slightly about 10% or just maybe less than 10%. The PEG ratios are not very favorable for India at this point of time. So from a valuation perspective, the market has corrected relative to its historical premium, but maybe not still in the value zone. Moving on from this, we'll jump through to some of our regular slides. So the challenge in India is that the last 2 years, financial 25 and 26, are both single-digit years in terms of earnings growth, 3% and 5%. Now that's a challenge when you have a market which is still quite expensive. As you remember in the previous slide, we are the only other market more expensive than India is the US. And of course, we know that in the US, earnings estimates are actually continuing to move up at this point of time because of the AI-led investment boom. And their earnings numbers are, mid-teen and higher. Of course, for March 27, India's current earnings growth estimates are 15%, much better than where we were in the last 2 years. Some risk to this, we'll talk about that later. So jumping on from that to the next slide, I think, this tracks the NSE 500 companies, and it tracks the number of NSE 500 companies. So these are the 500 largest companies in India. How many of them are growing faster than 10% year on year, both in terms of revenue and in terms of profits? So after a very subdued period in the middle of this chart, you can see that in the last 2 quarters, there has been a bit of an inflection point and an upward trajectory. So certainly the trajectory was improving. Now we'll have to digest what happens as a result of the entire Middle East conflict. Bouncing on to the next chart. Right. So this is what I referred to earlier. The bar is quite high in terms of 15% earnings growth expectation, both for March 27 and March 28. Historically, past energy shocks have led to downgrades in Indian earnings. The earnings downgrades have been anywhere between 5% to 11%. I think the median is somewhere around a 6% number. So that's sort of the risk to earnings, given that we know that this supply disruption has now persisted for almost the last 3 months. Moving on from that to the next set of slides. These are basically valuation slides, not much to add over there, except to say when you look at the large cap companies, their valuations now are right in the middle of that white zone, which is the fair value zone. This is both on a trailing PE basis as well as on a forward PE multiple basis. On the next slide, we have the price to book multiples. Here, in fact, it is not just in the fair value zone, it is below the long-term average. So I think, as far as large cap companies are concerned, this is some evidence that valuations are quite reasonably placed. And on the right side, you can see the return on equity of those top 50 companies compared to the history of 10 years over here. Our ROEs are still closer to the highs of this last 10-year period, but price to book correspondingly is at the lower end of that 10-year range. And that's where we get our comfort on India's long-term valuations on a bottom-up basis. We're not talking about relative to other geographies. Uh, where is this price comfort or valuation comfort still not visible? Left hand side is the Nifty Midcap 150, which is a measure of midcap valuations on price to book, still in the expensive territory. Similarly, on the right hand side, Nifty Small Cap 250, once again, that indicator in price to book is in that expensive zone. So the large caps we have comfort, but we don't have the same in mid caps and small caps. Finally, moving on to just sort of a summation on all of this. No doubt that the supply chain is disrupted, elevated crude oil prices pose a risk to India's macroeconomic stability. Inflation forecasts have been raised by 50 basis points by the RBI. But having said that, what I would jump to is point number 5, which is to say that I think the playbook that RBI and government have brought forward in the last 1 week significantly addresses some of those risks to the BOP. As I said, based on estimates, what could have been a 70 to 90 billion dollar deficit on capital account, almost 70 billion of that is now perhaps going to be addressed by the NRI deposits scheme, which is the FCNRB. In fact, based on calculations from brokers, anybody who is a non-resident Indian and has access to that scheme may want to call their banker and figure out how attractive an investment in those FCNRB deposits might be. March 26 earnings, I talked about that earlier. There was an uptick in that quarter. Estimated growth for 27 still remains quite high at 15%. There is some risk to that the longer this disruption continues. But I think the fact that the government has effectively absorbed this and they've done a good job of rolling out the fiscal, armory at their disposal, the net impact on the economy is 20 basis points. So it's not as dramatic as one might have worried about. We've already talked about the valuations. And as all of you would be well aware, the last few years have been very strong for value as a factor in the outcomes that fund managers have experienced in India. But we do think that this 5-year trend is likely to see a inflection point. We've been saying that for the last year and a half. It's been disappointing to not see that play out. But I do think that, given the sort of mean reversion tendency that it has, the odds remain quite favorably stacked. So that's it from my side in terms of giving you a rundown of the broad macro. But I'll hand over now to Ajay, and he'll talk in more detail about the India Dynamic Equity Fund. Over to you, Ajay.
Yeah, thank you, Vetri, and welcome everyone. And good morning, good afternoon, and good evening. So I'll start as is customary with a very quick run into our philosophy. What does the UTI India Dynamic Equity Fund stand for? And many of you tracking us or having invested in us are already aware that we are driven by the core principles of investing into high quality businesses, which we define as businesses which are creating economic value, stakeholders. And we obviously try to measure these core characteristics by way of the steadiness of return on capital, the steadiness of cash flows, the absence of high debt on the balance sheets, and so on. So these are very, very critical, I would say, characteristics that we want to observe in the invest in. And once we have chosen such businesses, we are fine if some of these vectors move up and down. They shouldn't structurally continue to just move one way down. So that's something which gives us a big alert and leads us to eventually exiting such businesses. But equally, we are very passionate about growth. We want the economic value creation of our chosen businesses to keep compounding at a rate higher than the nominal GDP rate of the country. As we are well aware, the nominal GDP growth of India and therefore the overall earnings growth of the broad market are is a number which is somewhere around 11 to 12%. We therefore want our businesses to be growing at 15, 16%. Once again, there will obviously be those odd years when this number could undershoot just like it could overshoot. What we are looking for is a structural through the cycle average growth of around 15, 16%, which basically is 300 to 400 basis points higher than the overall earnings growth of the market. The last bit is obviously valuation, and sometimes just because of valuations being unfavorable, we wait it out for a few quarters, and I can remember waiting out for a couple of years as well. We do want owning great businesses, but that doesn't mean that we own them at any price. So sometimes that also leads to a bit of a wait, but that wait is worth it because ultimately, as investors, we are interested in the future returns by owning the stocks of these great businesses rather than just observing the outcomes of these great businesses, and that can happen only when we always have the valuation discipline in front of us. Yeah, so with that, let us quickly talk about the performance. Once again, for many of you tracking our fund or having invested in our fund, the performance over the last few years has been a bit of a struggle. As we are well aware, quality as a style factor hasn't been delivering globally. So is the case in India as well. Quality as a style factor hasn't delivered. But yes, the only good news is that over the last few months, as markets have been a bit cautious, just like I would say a risk off phenomena that we are observing in global markets over the last couple of months. We've seen a risk off here in India as well. And that has, of course, led to interest revive towards the high quality, steady businesses, which, regardless of market environment, continue with their reasonably strong earnings trajectory. And historically as well, we have observed that during bullish phases, while the value factor does well, but it's during turbulent times the quality factor starts to perform much better. So I think we are just about entering into that phase. In any case, if we look at for how long the value factor has worked in India, that itself, the longevity of that period, which is significantly higher than any time in the past, tells us that reversion to mean is already overdue. Let's move on and let's look at the performance attribution over the last 1 year. What's hurt us clearly are some of the consumer names. This is both in the consumer services side as well as consumer durables. I will cover that in slightly more detail subsequently in terms of what is leading to our excitement in the consumer part of the market and why are we so overweight on consumption in general. Equally, not owning commodities has hurt us. The fund traditionally has not been able to find great compounders and great high quality businesses in metals and minings. Of course, this is a sector which is highly volatile. You have to time your entry in and also time your exit out of these businesses very well to make good returns. And that's something which we don't practice in this strategy. The strategy is more about finding the structural winners, riding on India's growing middle class, growing per capita income, and therefore growing consumption. That's the core of this strategy. And of course, which also means that we have, always been overweight on consumption. That's hurt us in the last few years. But once again, we think that that's already turning around. There is early evidence already over the last couple of quarters, but I'll talk about that in a bit. But in the meantime, let's move on and let's look at the key contributors from a stock perspective. On the left-hand side are the contributors. Not owning some of the large cap IT names has helped us. Not owning Reliance, the largest company by market cap in India, has also helped us. But equally, some of the consumer names like Titan have done well. Some of the healthcare names like Dr. Lal Path Labs have done well for us. What's not worked for us, like I mentioned, are quite a few names from the consumption side, both consumer services and consumer durables. Not owning commodity names like Hindalco and Vedanta have also hurt us. So, the stocks, the drags from these individual stock names is in consonance with the drags that we are seeing at the sectoral level, really. But let's move on and let's discuss a couple of portfolio names. We always try to cover a few names which we wouldn't have talked about over the last 3 or 4 quarters. So this time, for the first time, we are talking about Bharti Airtel, India's largest telecom company. With and by the way, India's telecom market has already become a duopoly. So there is massive pricing power that the two largest players are enjoying. Between the two of them, they have a 80% market share. The market was actually a very solid market up until 2012, but that's when multiple new players came in, and it was a bloody battle for survival between 2012 to almost 2020. Things started mending in 2020, and from there on, we've seen the markets just shrink to two large players and two very, very subscale players. So clearly, the pricing power has come back, and because of which we have seen a massive improvement in free cash flows. As you would see on the next slide, the good news still is that ARPUs in India are just about $2.50 US dollars per month. And you can compare that to any country. Obviously, the comparison makes sense when you draw a parallel between India and emerging markets. And once again, you would realize that the ARPUs are abysmally poor in India. But given the pricing power, we are seeing a steady increase in ARPUs over time. As we all know, the nature of this business is that ARPUs just flow through the operating profits and the bottom line, because a lot of capex which needs to be done has already been done. Telecom penetration is already very high. Players have made investments for 5G. Maybe they'll have to make some investments for 6G in the future. But a whole lot of this ARPU increase is simply flowing into the bottom line, as you can see on the top right-hand side bar chart. The blue line there signifies the escape velocity of the free cash flows over the last 4 or 5 years. Let's move on to another stock idea from our portfolio. Once again, we are discussing M&M for the first time here, and this is India's largest company in terms of the farm equipment. It is also one of the largest companies, in fact, the third largest company in terms of passenger cars, with their specialized niche being in utility vehicles, and that too premium utility vehicles. They hold a significant market share, about 25% in terms of SUVs at the aggregate level. In premium SUVs, the market share is closer to 50%. The company obviously has a very rich pipeline in terms of the new model launches that they would be coming up with on the ICE platform. But what keeps us excited about this company is the efforts that they've been making on the electric and the EVs basically as well. And they've been actually at the forefront in making EV launches. In terms of return on equity and return on capital, very, very strong. As you can see on the next slide, in terms of growth outcomes, once again, very strong. It's always heartening to see when businesses show strong volume growth, which is the real driver for revenue growth rather than just pricing power or just premiumization. So this company, while growing at mid-teens, has seen a big part of this growth come from volume growth itself rather than premiumization. But yes, premiumization remains a key theme in a country like India, with per capita income still being south of $3,000. There is obviously a very, very strong scope across the board, across industry categories, to witness premiumization. And I think autos as a sector in India, both passenger cars and utility vehicles, will continue seeing improvement in terms of realizations as premiumization continues to happen. Let's move on and have a look at the sectoral exposure. Once again, you are aware that we have a very low churn strategy, and that manifests itself into this slide that we show you every quarter. not much change between our current portfolio composition in terms of sectors versus what it was exactly 1 year back. Of course, there are some mark-to-market changes. There are also some changes that we make in terms of consciously increasing or decreasing exposure. Over the last 6 months, we have increased exposure in some of the consumer services names, which actually saw a big correction. When you go to the next slide, you can see the portfolio holdings once again, where they are today in terms of the top 15 stocks versus what was the same slide like, or the same picture like exactly 1 year back. Once again, not much changes, some mark-to-market changes, some changes in terms of consciously increasing exposure by us. So for instance, Eternal is one of those stocks which actually hasn't done well, but has inched up, in terms of its allocation. That's because we've been continuously increasing exposure to Eternal over the last 6 to 9 months. Let's move on from here. And, I did speak about our bullishness on consumption and the reasons for that. Let me first talk about the reasons. I'll talk about the early evidence that we are already seeing here. So, the government of India in the last financial year did two things. They did realize that private consumption has seen a slack over the last 2 to 3 years. And they did realize the importance of consumption in India basis the fact that 65% of India's GDP is linked to domestic consumption. Therefore, they made efforts to uh, push consumption in the country. The first effort was in terms of income tax breaks given to the households at large, and that figure at the aggregate level amounted to about $11 billion. Sometime in the middle of the previous financial year, they also announced rationalization of GST, or the indirect tax rates in India. And basis this rationalization, once again, approximately $22 billion was the net savings to households. So put together, this is a 33 billion kind of a number, not a small number for an economy which is approximately $4 trillion in size. So we are really talking about 1% of GDP being given as incentives to households, or let's say net savings to households to help them, kickstart consumption and help them consume more. But that's not it. If you go to the next slide, we are about to witness what is a once in a decade phenomena. In India, we still have a reasonable chunk of the workforce working for the federal government. We also call it the central government, and the state governments. Now, once every 10 years, the government revises the pay scales of these employees. And of course, when the pay scale are revised, there is a massive jump that happens to the salaries. And at the same time, there is also what is called as arrears, which are given for some of the previous years. Now, rough maths, by the way, the pay commission recommendations are still not out, but we are working on expectations, and these expectations are related to the average hikes that we have seen in the previous pay commissions. And this number alone will work out to $27 billion. In the previous times, whenever pay commissions have happened, we have seen consumers go on a binge in the following years, basis the benefits and the bounty given to them. And if you look at these three factors or benefits to the households in a combined manner, we are really talking about a very solid number, something close to 1.4 to 1.5% of GDP, and this is going to be a recurring phenomena every year. This is not one time. So I think the coming years, we should see a lot of strength in consumption. Of course, consumption has been weak over the last few years, but we keep reminding ourselves that the real story of India is all about the positive demographics. Therefore, people every year, joining the workforce, and these people ultimately joining the middle class, and with the middle class continuously expanding and also witnessing increase in per capita income, the consumption trends remaining fairly strong for decades to come. And it is on this basis and our faith in this particular phenomena continuing for the coming decades that we remain absolutely convinced about holding a very strong and overweight position in the consumer sector. By the way, the sector has also not been performing very well over the last few years, which means that valuations have become much more attractive compared to what they were in 2022 or 23. So, Yeah, with that, I will end my part of the presentation. I hand it back to Neha for opening up Q&A.
Thank you, Ajay, for that insightful deep down in such short time. Appreciate the honesty and all the detail. Let's now open the floor for questions. I already see a couple of questions coming into our chat box. Let's take up the first one, maybe for you, Vetri. How has the RBI stepped in recently to manage the rupee? How long does it usually take for these interventions to show up? And what is the medium term outlook for INR?
Sure. Um, as I said, they're actually using the same playbook that they used in 2013, particularly in the FCNR-B scheme and in the external commercial borrowing scheme. Neha, last time they managed to raise almost $34 billion in the short span of about, I think, 6 or 7 months. This time, and at that point of time, $34 billion was 12% of the total foreign exchange reserves that India had 13 years ago. Today, if we look at where we are in terms of about 680, $90 billion of FX reserves, and if I go by some of the estimates that people have that this could raise about 60 to $70 billion, that would be about 10% of reserves. So I would say they've rolled out pretty much the same bazooka. They have made the rules even more attractive for those who wish to use this route to bring in the money. A very valid question at this point would be who's bearing the cost of this? Back of the envelope, our sense, if we look at about 50 to $70 billion coming in, the cost to the RBI of effectively backstopping the foreign exchange rate on these capital inflows would be anywhere in the region of about $2.8 billion a year. And that's presuming that nothing changes in terms of the forward premium on the rupee and nothing changes in terms of the FX rate itself. So given that, Neha, I think this is a very, very significant policy announcement that they've made. It will have some impact on the RBI's profitability. But remember, the RBI, for example, last year paid a dividend of $30 billion to the Treasury. So, if they have to bear $2.5 billion of cost, it's quite insignificant to them in the larger scheme of things. So I think it will have a significant impact. Last time, of course, the rupee was in a much more damaging fall. It fell almost 24% in about 7 or 8 months. But then it retraced almost half of that once these policy announcements came through. My sense is over the next few months, you should see the rupee stabilize. I'm not going to warrant something in terms of, will it pull back 5%, 7%? That's hard to say. But I think this puts a floor against, sort of a self-fulfilling vicious cycle in the market, which was causing the rupee to fall. I think you're on mute, Neha.
Sorry. Thank you, Vetri. Maybe another question for you. What are the current trends in foreign and domestic capital flows?
Right. So I think in terms of capital flows, we've already covered that foreign, interest in Indian equities is muted as reflected in that trend, minus $46 billion over the last 2 years. Domestic appetite, Neha, still remains quite strong. The Indian mutual fund industry is seeing almost about $3 billion of inflows through what we call systematic investment on a monthly basis. Over and above that, of course, there are flows from the domestic insurers and others as well. So I would say the domestic bit still remains quite strong, and that's a source of support. And at the same time, activity levels in terms of fundraising, there's a little bit of cool off in the last 45 days as the conflict has continued, but I do think that overall supply of paper will remain reasonable. So I would say no major change in trend. One of the things that a foreign investor told me recently is that the challenge to allocate capital to India is that it is not cheap enough to attract value investors, and it is not growthy enough to attract growth investors. So that's sort of the challenge that investors are facing right now.
Thank you, Vetri. Maybe the next question seems to be more fund position related. So, Ajay, for you, what macroeconomic headwinds are currently pressuring Indian economies, and how is our portfolio strategy positioned to mitigate these risks and capture alpha?
Sure. So, the most topical risk that we are discussing, debating, and I think Vetri spent a fair amount of time on that is basically the risk coming in on account of the West Asia crisis. So basically, it's the energy prices, but more than that, energy supply. So I think that's the big risk which has unfolded over the last couple of months. Now, look. While we don't know what will hit us, what kind of curveball will hit us from one year to another, but the reason why we are so passionate about building a portfolio around high quality businesses is exactly what this question is trying to address. You could see the risk coming out from different parts of the market, and there could be different factors. But if you're essentially into businesses which have pricing power, you are into businesses which are not financially leveraged, which means that even if revenues and profits go down for a few quarters, they're not under existential threat because they have to service their debt and so on. If you are into businesses that are anyway generating strong cash flows, which means that these businesses need not wait for the environment to become good to do incremental capex for future growth, then I think you have, in a way, covered yourselves and insulated yourselves from all exogenous variables. That doesn't mean that their stock prices don't fall, but I think what we keep reminding ourselves is that the real alpha that we generate from our portfolio is basis the economic value compounding that our underlying businesses are witnessing. Because of all the factors that I just mentioned, if businesses are going to continue and work out their strategies, as if nothing has happened, continue committing themselves for incremental capex, not getting bothered about, fixing the problems around the balance sheet, then I think their essential economic compounding will continue. And it's just a matter of time when, risk of phase passes, markets once again start to look at the potential of such businesses in terms of creating earnings led value well into the future, and once again starting to reward them. So in a way, I've just given a poetic answer or a very philosophical answer to your question, but that's how we look at all kinds of risks. This time, the risk is coming from West Asia on account of the energy crisis. The risk could be something else. We've navigated through all of these risks over the last couple of decades. Bases are very, very strong focus on very strong businesses which have a long growth runway in front of them. Yeah.
Thank you, Ajay. The next question, maybe for you, Petri. I think it's a question a lot of investors invested in India asking: what factors explain the time correction and stagnant returns in Indian equities over the last 24 months?
Oh, okay. Well, I'd say pretty much what I, answered in the last question as well. Starting valuations too expensive, so that's one challenge. And then we haven't delivered on the kind of growth expectations that people had. Just keep in mind that between 2020 and 2024, which is a 4-year period, Indian corporate earnings, Nifty 50 to be precise, so top 50 companies, literally doubled, right? So that is a compounded rate of growth of about 18%. And if I look at the small and mid caps, I don't have it handy right now, but I think the growth rate there would be even higher than 18% over that same 4-year period. So, you have to keep that in mind that that was a 4-year period when maybe many other markets were struggling to deliver earnings growth, and India compounded at, 18 to maybe 22, 23% during that period. And the lack of growth thereafter, with 2 years of single digit earnings and the starting valuations being elevated, to my mind, there's no need to look anywhere beyond these valuations and weak earnings growth to sort of understand why performance has been weak. Beyond that, it's all narratives. I don't really buy the whole AI piece. There are too many markets without AI which have done well in the last year and a half. But yeah, I mean, it is what it is.
Thank you, Petri. The next question for you, Ajay. Are we seeing the impact of fiscal and structural government policies taken in the last 12 months on aggregate private consumption and consumer demand patterns in India?
Neha, the answer to this is yes. We have seen impact of these measures on consumer behavior. the more discretionary consumer behavior had started to manifest itself in terms of higher purchases in the months of October, November, December itself last year. I'm talking here about the sales of automobiles, seeing a very, very sharp uptick in those months. That's followed through, by the way. But I would say the more non-discretionary items, the more low-ticket items have also joined the party. And in the earnings that got announced over the last 4 to 6 weeks for the quarter ending March, we've actually seen after many, many years, and I'm talking about quarters, after many, many years, we've seen strong volume growth coming in from low-ticket consumption, companies as well. So very clearly, the uptick basis, the data that we discussed, we spoke about approximately 33 billion coming in already by way of income tax cuts and GST rationalization. I think the impact of that is already visible. Now, the one caution that I need to make here is that there will be a impact of higher energy prices on the consumer wallet that may lead to some bit of moderation of these trends that we have already started to witness. But hopefully, that also should get addressed. We are not looking at crude prices remaining like this forever. Hopefully, it gets addressed in the next 3 to 6 months. And since we've already got a glimpse of what the impact of these savings by households already is, I would say we would return back to such strong consumption patterns once again. Yeah.
Thank you, Ajay. And maybe in the interest of time, we'll take the last two questions. So the next question for you, Betri. What structural shifts and policy initiatives is India implementing to enhance its energy security and reduce its fiscal vulnerability to crude oil imports?
Very good question. And I must say this has been India's Achilles heel. And it's not that we didn't know this. I'd say, given our own experience going back to, pre-global financial crisis 2005, 2008, then again in 2013, we've always known that energy is our Achilles heel because our dependence on, large crude oil imports. Having said that, I think one of the things which is mitigating the impact for India this time around is that even though we are dependent for crude oil imports, we are not dependent on imports of refined products. And one of the things to keep in mind is that refining cracks have expanded dramatically this time around. So, in effect, having such large domestic refining capacity has meant that we have not had to absorb that shock. In a way, you could say it amounts to administered pricing, but really what it means is it gives you a policy tool to be able to tackle this lack of energy security that you have. I will just point to two things. If you look at the two biggest business groups in India, particularly on the capex side, the Reliance Group and the Adani Group, if you look at where their dollars are currently going in terms of investment, there's a very significant investment both groups are doing in terms of the entire solar ecosystem, right from panels to utility style generation products down to batteries. So I do think that in that sense, this is something which is getting tackled with the benefit of government policy, which has been very, very pro investments in solar. More than 30% of grid capacity is already coming from renewable, and we'll continue to take that number up. So I think there's a lot of hard work happening over there. God didn't bless us with crude oil, but they did bless us with sunshine and with coal. And therefore, we are doing what we can in terms of the sunshine factor. Just on coal, it's unfortunate that we haven't used our coal reserves as effectively as we should have. But just a few weeks ago, Government of India announced almost, I think, a $4 billion effective capital subsidy for coal gasification projects. And I think this is significant. It's not enough. It doesn't move the needle for the size of the economy, which is a $4 trillion economy. But I think if we can get gasification projects going, we can significantly pivot the production of fertilizers, which is currently either imported or from imported natural gas, to ammonia from the gasification route. And we have more coal in the ground that we can actually use than what we are likely to use in the next 50 to 100 years. So I think there's a significant scope for gasification to meet India's need for fertilizer security. And very good to see that the government has kicked off this gasification project in its policy announcement 2 weeks ago. So I think these are sum and substance of everything that we are doing to sort of reduce India's vulnerability to supply shocks and energy crude price shocks.
Thank you, Vetri. Let's maybe end this session with one last question for you, Ajay. What are your high conviction sector allocations for the near to midterm, and what are the core fundamental drivers behind these choices?
Sure, yeah. I think I've spoken about the consumption sector a fair bit over the last half an hour, so I won't repeat that. That clearly is a very high conviction area for us, and it covers the entire spectrum from discretionary consumption to what we call as items of consumer durables, consumer services, and so on. Yes, we are not as passionate about consumer staples, which basically covers what is traditionally known as the fast-moving consumer good companies, because we think that the penetration rates over there have already reached to a level which can lead to future growth rates being fairly anemic. So, X of that, X of the staples, I would say, category, we are excited about most of the other facets of consumption. As per capita income increases, consumer wallet will tilt towards more of the discretionary items, the durable items, and parts of consumer services. The other thing, which is very similar to the overall consumption theme, is the healthcare theme. I think here again, we are seeing Indian households spend a lot. Do remember, India is an out-of-pocket market, which means that rising per capita income and rising penetration of medical insurance will lead to higher spends in, once again, different parts of the pharma market. I'm talking about pharmaceutical drugs here. I'm talking about healthcare services, which includes diagnostic services, which includes the spend at private hospitals and so on. There is enough data to show that the correlation between rising per capita income and medical insurance on one side is very high with the healthcare spends. The third bit is more here and now. We are extremely passionate about IT services, having seen them see a very sharp sell-off basis the fact that IT could mean a bloody blow to them and could actually lead to their business models getting completely disrupted. Our own deep research into this area, and if we've been talking to a lot of people over the last 6 months. Our own views here are that, in fact, this could act as a massive opportunity for IT services players to increase their addressable market. They, of course, have to put in place a very strong strategy to ride on the opportunities that AI will bring in. But the world will use more of software, which means that the world would need a lot of hand holding to use those softwares. And that's where the role of IT services companies, or system integrators, as they're technically called, would come in. So yeah, two structural themes and one theme which makes a lot of positive case right now basis the massive sell-off that we have seen. Yeah.
Thank you, Ajay. Thank you, Vetri, and thank you all for taking the time and joining us today. If you still have questions, feel free to get in touch with your UTI sales representative for the same. Thank you.
Thank you, everybody.
Thank you, everyone.